I want to welcome you to our fourth Shale networking event. We started these a couple of years ago to try to bring together people who had an interest in what's going on with the shale resource in the state, thinking about what we could do in the way of research and how we might collaborate together. We try to bring in speakers who will provoke thought among the audience, and also to try to give us some new perspective and ideas on things. I want to take one moment, though, to thank Trina Wafel, who has organized all of these, and really this whole idea of these events was Trina's, and I want to thank her for that. Let's give Trina a round of applause, please. Right. And now I want to introduce the director of the WVU Energy Institute, Brian Anderson. He's going to tell us a little bit about what's been going on at the university in this area. And then after that, he will proceed with introductions for our speakers for the afternoon. Thank you. Brian.
Thank you, Fred. As you mentioned, you would like me to talk about what we're doing at WVU in the area of shale. And so I don't want to take up all the speakers' time, so I'm going to try to keep it short because we do have so much going on campus in shale research that it's a really exciting time. Just this week, I see in the back we have some visitors from Northeast Natural Energy and partnered with WVU, Ohio State, the Department of Energy on the world's first field test site in the academic world, the Marcellus Shale Energy and Environment Laboratory. The MSEAL project is moving forward in really an amazing collaboration with Northeast and WVU and the DOE and Ohio State. And just this week, stimulation on 2 production wells will start at the MCL site in the Morgantown Industrial Park just south of town, really capping off what has been a year of tremendous collaboration. And if we back up to the beginning of the summer, the weather here in Morgantown didn't quite cooperate, but provided a change in plans for the science well and coring, where Northeast and their industrial partners were very flexible and ended up coming out of that with some great success in retrieving 111 out of 120 feet of core, which is an incredible recovery of core through the Marcellus and into the Onondaga below the Marcellus, and that really those cores are being processed across the country at NETL and out in Utah. And so this is really a landmark couple weeks for the MCL project. That's in the upstream side, as well as a lot of different partnerships that Tim Carr is working on with our international partners through the Department of State and in a couple of different countries around the world who want to learn how we're doing shale production in the United States, have been coming increasingly to us through the Department of State, and Tim is keeping extremely busy in developing these relationships and finding ways to have training programs. So those are 2 of the highlights in the upstream area. In the downstream, shale gas utilization, which has connections to today's topic, is the updates are that we've had 2 candidates on campus recently for the shale gas Statler chair in natural gas utilization, and we had 3 external candidates, 1 from on campus, and as many of you were in those presentations, we ended up getting some extremely well qualified and exciting candidates onto campus, and we hope that within the next few months we will be able to, and perhaps even a shorter time, announce the hiring of our new Statler chair in that area to head a group of faculty who are working very energetically at the moment across the university. We have 8 faculty who have been hired in that shale gas utilization mountain of excellence, 2 in engineering who've had some early successes. I don't see Henjin here, but Henjin Tian has received an NSF award for collaboration between the U.S. and China, a pretty large NSF grant there in his first year, doing very well, as well as Cosmin Dimitrescu in mechanical engineering I see here, and they're forging forward with their own research projects, as well as I see Levin here from the Davis College, in the area of resource economics, really hitting the ground running, and as well as our partners over in public administration and law. So there's really a great cohort of excited faculty, which I believe have a lot of posters that you'll see some more details about their work. But in the shale gas utilization area, just 2 weeks ago, there was also a historic event here that WVU was involved in. The governors of West Virginia, Pennsylvania, and Ohio signed a memorandum of collaboration between the 3 states that they're going to work together in areas of marketing and public publicity between the states as a region for downstream natural gas utilization development. So the four areas of collaboration: publicity and marketing, research, which we will be a strong component of that relationship, infrastructure, and workforce development, again, where the universities will play a role. This is really, again, a historic event where 3 governors are coming together to create a super state, in a sense, to try to attract outside industry to the region. And at that meeting, we had Senator Manchin spoke, as well as the governor of West Virginia, the lieutenant governor of Ohio, and by video, the governor of Pennsylvania. He has a travel hold and travel freeze on all administrative travel, so he couldn't make it, but sent his remarks by video. Additionally, next month, in November, the College of Engineering will be hosting a roundtable. It'll be a roundtable of industry experts in the area of downstream gas utilization on campus, and really to try to attract ideas from the outside. And this is by invitation only, because there's been such a response from those who have been invited that there will be a tremendous amount of energy from the downstream areas. Now, of course, all this is predicated on the amount of gas you can produce and what you're using that gas for. And so that's what brings us to today's topic, because as we know, about a year ago, a little more than a year ago, the price of oil started sliding, and it lost about 50% of that price of oil. Well, in the region, that created some waves, because we have 3 major cracker facilities under various stages of planning, and the finance of that is extremely important. So understanding where the world oil market's going, where the world natural gas market is going, and where this region in West Virginia sit in that worldwide natural gas and oil market is extremely important as we look forward into potential research topic areas, collaboration with industry, and then investment in the state. So that's where we stand in a nutshell. If you have I don't want to go on any longer than I have, but it really is an extremely exciting time at WVU, specifically in this area of shale gas, both upstream and downstream. So today, per the invitation of the new chairperson in the Department of Finance, Naomi Boyd, we have our speaker, and I'll let Naomi introduce our speaker, but since Naomi is new, it deserves an introduction of Dr. Boyd. She is, as I mentioned, the new chairperson in Department of Finance, and an associate professor in finance as well. Her PhD is from George Washington University with an MBA from Texas Tech, and we'll forgive you for that as long as we beat them on November 7th at noon on Fox Sports 1. There is an interesting fact about Naomi's background, is that her undergraduate is in dance from another Big 12 partner at UT Austin. Naomi was a co-worker with Botan at the Commodities Finance Trading Commission. Is that right? Futures, yes. Commodities Futures.
Just say CFTC.
Yeah, the CFTC, where she got to know Bahadurin's work and led to this invitation today. So I'll hand it over to Naomi, but thank you for arranging this invitation.
Thank you. So I was asked to speak a little bit about the things that are happening in the Department of Finance, and then I will quickly move on and introduce who we're all here to hear from today. We rolled out in the Department of Finance, actually specifically Paul Speaker, has really been spearheading our efforts in energy finance. This past year, we headed up or rolled out a master's program with a concentration in energy finance. We had 17 students going through those courses this summer, so we're really excited about that. We're also working on an area of emphasis at the undergraduate level in energy finance. We look at this as a real opportunity to broaden our base of potential job opportunities for our students, and potentially as we grow in shale gas, as we grow in energy as a state, provide opportunities to also keep our WVU students here in the state of West Virginia. So that's in a nutshell what we have going on in terms of academic programmatics, and we're really excited about where that's going to take us in the future, and grow our department and grow the overall network of energy here at West Virginia University. So without further ado, I want to introduce my very good friend and former colleague, Bahatin Buyuk Sahin. We worked together for 5 years at the Commodity Futures Trading Commission, and after he left the Commodity Futures Trading Commission, he went to Paris and worked at the International Energy Agency. And now he serves as the policy advisor of commodities at the Bank of Canada and heads up all of their research in commodities markets. He speaks all over the world. He has a wealth of knowledge in oil as well as in natural gas, and so it is my absolute distinct pleasure to have him here in Morgantown and have him talk to you all about these very, very timely topics. So without further ado, I will turn over the floor to Bahatin.
First of all, thank you for kind remarks. As Naomi I'm Bahatin Buyuk Sahin. Currently, I'm heading the Commodities Research Division at the Bank of Canada. And as a policy advisor today, I'll be discussing shale revolution and implication for world energy markets. Before that, I should tell my story about energy markets maybe. I started working on energy market actually in 2006 or something, just after the Amaranth crisis, basically. You remember in 2006, September of 2006, Brian Hunter basically just single man just collapsed all the $7 billion worth of Amaranth. And I started working on that topic, then I moved to crude oil and all this stuff. So today I want to focus my attention on shale revolution in the US. Basically, yes, shale resources available all over the world, but today's topic mainly focused on the shale revolution in the US. I'll start my presentation by giving general overview of this revolution, then I will go into detail to discuss what this revolution means for global oil and gas markets. And finally, I will discuss a long-term outlook for energy market, basically gas and oil market, especially in the light of recent decline in oil prices. Basically, the technological advance has completely changed North American energy industry since mid-2000. Once considered costly or difficult to extract, large deposits of natural gas and crude oil are now accessible. US gas production increased by about 30% since 2007, and Canada production declined actually. Mexico production stagnated. Regional prices declined by almost 70% during 2008 and 2014 periods. Basically, this in turn benefited the downstream and power generation sector. The increase in oil production in Canada and US during 2005 and 2014 is really matched the increase in the global oil production. So, what is this revolution or shale stuff? Basically, shale resources refer to the extraction of a new, unconventional energy resources from shale formation. Shale resources are more difficult to access than conventional resources since it is usually buried deeper in the ground and occupies a shallower space. The extraction of shale resources has been made possible by technological advance over the last decade, namely horizontal drilling and another technique called hydraulic fracturing, which essentially breaks up the surrounding rock so that gas and oil can more easily flow out. The development of those technological first applied to shale formation containing natural gas. The Barnett Shale formation in Texas was among the first to be developed. The emergence of shale gas has led to resurgence in US gas production since 2005. Importantly, the EIA, Energy Information Administration, who is probably the most authoritative figure in terms of US energy sector, was surprised on the upside by how quick shale developed. The IEA predicted in 2005 that US natural gas production was to reach just 21 trillion cubic feet by 2014. Output stood at 26 trillion cubic feet last year and 25% upward revision relative to 2005 forecast. This revision or forecast is much, much smaller than shale oil development. Basically, they were completely surprised by how quickly and how much shale oil production increased. For example, if we look at this figure, blue line show that 2002 projection for EIA projection for US crude oil production. They were just forecasting crude oil production just below 6 million barrels per day in 2015. In 2013 projection, they were expecting almost 7.3 million barrel per day production in the US. The actual number stood at 9 points at some point, especially in April when it peaked, it stood at 9.5 million barrel. Sorry, can I have? Thank you. Basically, this with the success of shale gas, the same techniques were then applied to extraction of oil. The experience with the shale oil also yielded astonishing gains in the output. US oil production had been in structural decline since the 1980s, and up until recently, even the most authoritative figures in the US, basically EIA, oil market did not foresee a significant reversal of this trend. So, however, that was indeed what happened since 2010. Essentially, many small and medium-sized firms in the US were encouraged by high oil prices over the last decade to invest in previously inaccessible shale formation. This chart basically shows that since 2010, US oil production has vastly outperformed previous forecasts of output by the EIA. It's not only EIA, it's also IEA or OPEC were surprised by increase in production of shale oil. Actually, when I was talking to OPEC and its officials, they were, up until 2011, 2012, they were just saying that this is just temporal increase. So they did not realize how competitive shale oil will be against their own conventional oil. So even though the shale revolution first started in the United States, shale resources can be found in abundance around the world. This chart basically shows EIA assessment of shale resources. Both oil and gas can be found on every continent. They exist in both all countries, a lot of countries that have abundance of conventional energy resources, such as Russia, and in countries where there is limited conventional resources, such as China and Argentina. Let's look at shale gas resources. If you look at, for example, China has the largest resources, technically recoverable, of course, resources, gas resources available. According to EIA assessment of potential shale resources, countries outside of the US have far greater reserves than what is found in the US. For example, China has about 1 trillion cubic feet of shale gas reserves, compared to about 700 trillion cubic feet for the US. This is technically recoverable. Proven, on the other hand, basically with the current economic condition and with the current technological stuff, it is about 365 trillion. In all, the US represents just about 10 to 20% of world shale reserves. If you look at shale oil, this is similar to natural gas. There is also abundance of shale oil outside of the United States. In all, the US represents just about 10 to 20% of world shale formation reserves for both oil and natural gas. The countries most likely to be next in developing shale resources include Argentina, Canada, and China. Other countries such as Russia and Mexico still have much conventional energy resources to be extracted before they would need to turn to shale resources. But the thing is, how much our expectation from, let's say, the China, in basically, according to IEA estimation, we are expecting only 600 KBD production of shale oil by 2030. It is not much, but you might be surprised how quickly they might be able to produce more shale oil. One of the most important contributions from the shale revolution was that it increased potential reserves. The increase is especially substantial for natural gas. With shale gas becoming a viable resource, the increase in technically recoverable natural gas reserves in the world increased by 50%. Shale gas now accounts for about a third of total recoverable natural gas reserves globally. Shale has also increased potential oil reserves, although to a lesser extent. World oil reserves increased about 10% with an inclusion and the development of shale resources. This is really important. Basically, main increase in shale came from US shale gas, and it increased the world resources by 1/3. And while the other one, basically, it is just 10%. That is how we should be seeing this one. It is completely different area, and shale oil revolution marginal contribution is much less than shale gas. Next question you might ask, can the US shale revolution be replicated? Yes, it can. It has the potential, but the reality is completely different. Basically, although US had a unique attributes that may not exist elsewhere. Basically, if you look at the property rights, for example, it is clearly defined. For example, underground resources are available to landowners. In Russia, for example, it is state-owned. There is no probability that independent or small or medium-sized enterprise can go and develop shale gas or shale oil, as opposed to US. US invested a lot of resources in this technology. Basically, a decade of high prices encouraged investment. Basically, well, the same thing happened when the prices are so low right now. Of course, The next thing is basically there are lots of advanced drilling equipment and pipeline network already in place here, as opposed to other countries. The question is, what if shale reserves are gone here? The same technology transfer to other countries, yes, but still we need to have oil and regulatory changes over there. Of course, rapid diffusion of already mature technology to other countries represent an upside risk to production in other countries, but we do not see this probability in the near term. But our expectation is that after 2020, we might see an increase in shale oil and shale gas production in other countries, especially starting with Argentina. So, what are the implications for shale revolution? Especially, let's start with implication for gas markets. Oh, by the way, if you have any question, you can please stop me to ask. You don't have to wait till the end of the presentation.
Can I ask
Yes.
a question? With regards to China, are those, my understanding was a lot of the shale deposits in China are already under areas that are where there is a lot of development. There's, bigger cities and a lot of, other infrastructure that's in place. So is that correct, or is that, so in other words, even though they have the deposits that are technically recoverable, it's not going to be economical to kind of explore, exploit those resources?
As far as I understand, no, there are lots of resources also East China, where not much development occurred, especially, I call it East Turkestan, but they call it Shanghai or whatever. That region has a lot of potential also. So yes, it is true. West China also has also a lot of recoverable. I'm talking about recoverable, not resources. But still, especially shale oil, we do not expect any meaningful increase in production up until 2025, 2030. And the numbers forecasts suggest only 600 KBD. Although they have the largest, for example, in terms of shale gas, largest recoverable resources. Yeah. Basically, if you look at this graph, it is suggesting that U.S. on the way becoming a net gas exporter. Let's first examine the experience of the United States, where this so-called revolution took place. With greater domestic energy supply, the U.S. is becoming more self-sufficient in its energy consumption. Looking at natural gas imports specifically, we can see that U.S. net imports have been falling steadily since the emergence of shale production. There are signs that in 2015, U.S. net imports has fallen close to zero. With the expected trajectory of continued natural gas production growth, it is highly likely that United States will become an important net exporter of natural gas within this decade through especially LNG exports. I was talking especially, our expectation, especially after 2017, LNG exports should increase dramatically with the expansion of Panama Canal, allowing larger ships to go and then cutting transportation costs 1/3. This is an important implication for in especially competitive Asian market, where U.S. is expected to compete with Australia, Qatar, and Iran, and also somewhat Canada. Here, this is an interesting graph. Basically, this shows Canada oil exports to U.S. With Canada responsible for about half of U.S. natural gas imports, greater self-sufficiency in the U.S. market has meant reduced demand for Canadian gas. This shift in U.S. natural gas market has been problematic for Canadian natural gas producers. Canadian producers have had to make some adjustment, and those adjustments took some time. The US is currently the only viable destination for Canadian natural gas, and substantial investment in the capacity and construction time was needed before Canadian natural gas can access another market. The shift in global natural trade routes caused by shale revolution that will be discussed in the greater detail in just a moment. But the important thing over here, basically, even Canada starts building LNG export facilities right now to export some natural gas to Asian market. It is going to take about 4 to 5 years before this costly LNG export terminal was built. Basically, Canada might be too late to enter into the market, and it is going to lose some first-comer advantages. Because generally, these markets are long-term contracts rather than short-term spot markets. So whoever comes first, they take the market share in general. But this shale revolution also led to divergence in natural gas prices between North America and other regions also. It is important to note that natural gas has historically been relatively regional and continental commodity, since producer and consumer cannot readily send or acquire natural gas to and from another region. Natural gas can only be transported via pipelines in its original state, or it can be transported via special tankers in its liquefied states, something that is known as LNG. In either case, however, this transportation capacity takes time to be put in place. Following the boom in the US natural gas production that surprised many people, there was some excess supply of natural gas that were landlocked because there was simply no infrastructure in place to send these supplies outside of North America. In fact, prior to shale boom, US were building several LNG import facilities. The excess supply, and then it is difficult and very costly to convert these LNG import facilities to export facility. So Canada had also built a lot of exports on the East Coast, but it's not working right now, most of them, because they are not exporting gas to US. The excess supply in the North American market pushed down prices locally. As you can see here, the Henry Hub price, the benchmark price for natural gas in North America, traded close to gas prices in Europe and Asia prior to 2009. But a wide discount is observed thereafter. Today, natural gas prices are $5 to $10 lower in North America than it is in Europe and Japan. Of course, the recent decline in gas prices, also oil prices, for example, if you look at blue line for Japan, now it is showing is about $9. Or Russia gas price is about $7 or something. In this environment, low price environment, export of LNG, export through LNG is also might be problematic in terms of profitability. So we might see, but as I'll come to my slide later, projection for crude oil prices to rise, so we are not going to see these low prices forever here. With the sharp decline in natural gas prices observed in recent years, prices may now be below the break-even cost of production in some shale gas fields. This chart depicts the ratio of present value revenue of a project against its initial investment at different price level of natural gas. The positive number means that project would be profitable and producer should undertake the investment in new production capacity. What we see quite clearly is that unless natural gas prices are above $3 per million BTU, projects in shale gas are not profitable. Natural gas prices have been persistently below $3 in 2015, well off their pre-2008 highs in recent years. Simple economics tells us that when prices fall, especially to levels below production cost, I mean operating cost, firms tend to cut back on investment, which should eventually result in a decline in production. But that doesn't mean everywhere we see this operating cost. Some places are much, much lower than these average prices. So we should be careful not characterizing every field as same. On the one hand, number of natural gas drilling rigs, basically if you look at natural gas production has grown despite a steady decline in drilling activity. What's happening? Why is that? Basically, sometimes more rigs means more production. Less rigs means less production. It's not the case, especially what we are seeing in oil also. On the one hand, the number of natural gas drilling rigs have declined drastically in the US since 2008, following the decline in oil prices rather closely. However, natural gas production has continued to expand despite less drilling activities. How can we explain this one? There are basically two main explanations. The first explanation is related to improvement in energy efficiency, offset lower rig counts. First, efficiency has improved immensely as technologies mature and workers develop more expertise. The charts provide estimates of how much gas was or is expected to be produced from new wells per average rig for the current and following months. This estimate is an indicator of rig productivity that encompasses both the time it takes to drill a new well and the productivity of that well. Productivity, according to this measure, has nearly quadrupled since 2008. What this means is that less drilling is required to achieve the same amount of new production. Second, remember, back to the geology of shale resources shown earlier in the presentation, shale gas and shale oil are usually found in the same basin, and one is usually byproduct of the other when produced. What this means is that even though drilling for natural gas, shale wells have declined, those rigs were simply moved to the oil side, and natural gas also flow out with the extraction of shale oil. With oil prices elevated until just a year ago, the rapid development of shale oil also helped to prop up natural gas production. In fact, there has been times when natural gas prices were negative. Essentially, shale oil producer would pay for someone to take natural gas off their hands, since there is limit how much they are allowed to burn or release into the atmosphere. The second issue, gas is one of the cheaper methods of electricity generation at current price. Another way, basically, shale revolution is impacting U.S. energy landscape is that it is contributing to a shift across energy input for electricity generation. With natural gas prices less than $5 per million BTU, electricity generators running on natural gas are the one of the cheapest among different sources. Here, yellow bar depicts the cost of generation electricity using coal. Light blue bars are for technology used to generate electricity by natural gas, and red one are renewable technology. Basically, as you see, the blue bar is the lowest cost. That's why maybe Iran actually do not want to export natural gas per se. They want to produce electricity, then export electricity to its neighbor. And of course, most neighbors are not willing to take that risk because they do not trust Iran in their electricity environment or some stuff. Basically, electricity is much more expensive product to export. Of course, in the Iranian case, if I say something about, it's not the possibility of exportation of natural gas, but it is the current production technology is the problematic one. When I look at over there, Iran has almost 18% of world's gas resources, while only 1% of gas production. That is somehow, it's very disappointing for Iranian government also, but this has nothing to do with the sanction, yes, lately yes, but before the sanction, they could not export because of some pricing disputes and also technological state of Iranian firms and their unwillingness to negotiate with major oil and gas companies. Here, in addition to relatively low cost, natural gas plants are also much more environmentally friendly than coal plants, especially the older ones. The emergence of natural gas has helped the older and most costly coal plants in the US to retire in recent years. In fact, earlier this summer of the 200 coal plants since 2010 in the US was shut down, representing about 40% of previous coal plant capacity. As a result, we have a gradual but very clear shift from coal to natural gas for electricity generation. In 2002, coal represents nearly 50% of US electricity generation. And in 2014, it represented just 35%. On the other hand, the share of natural gas has risen from less than a quarter to about thirds during the same periods. Now, let's turn a little bit the implication for global natural gas markets everywhere. Historically, natural gas trades were mostly regional via pipelines. That's why when we talk about natural gas prices are regional while oil prices are global. Basically, when we talk about gas, there are three main regions: North America, Europe, and Asia. It's completely different. In North America, prices are determined by market forces. If you look at price discovery took place in the futures market, while in Europe, almost half of the gas prices are linked to oil prices. Half of them determined by negotiation very close to market prices. On the other hand, in Asia, it is almost all contracts are linked to oil and always carries a Asian premium. Basically, historically, as I said, natural gas trade were mostly regional via pipeline. Limited global LNG trade in Europe and Asia, mostly Japan. If you remember earthquake in Japan lost almost a lot of nuclear power, and then they substituted all this stuff with LNG imports. So, with growing domestic supplies, North American producers are looking to export excess natural gas to other continents via LNG. US began building major LNG export capacity in the Gulf Coast in recent years, and those capacities are expected to come online in large quantities in the coming years, especially starting 2017 and onwards. This chart from IEA shows that Qatar and Australia has already added substantial LNG export capacity during the 5 previous years. But over the next 5 years, the bulk of additional LNG capacity will be found in the US. But the thing is, who is going to be advantageous in Asian market? Of course, Australia is very close, but their LNG prices are very high due to cost of capex of this LNG stuff. And Qatar, very low, but it is far. But US might use its advantages, low prices, and also advantages of what's called new technology to export this stuff. My guess over there, Qatar starts redirecting its export to European markets, while US, Canada, and Australia fighting for market share in growing Asian markets. So basically, if you ask me, Iran, possibility of Iran moving into China and all this stuff, it is difficult because it requires a lot, almost $40 billion investment to carry Iranian gas to China. That is, who is going to take that big investments? China is not willing to, so it's going to be difficult. So Asia, as I said, is important for the global natural gas and LNG market because it is well on its way to becoming a center of demand. Global LNG demand is expected to grow by about 150 billion cubic meter over the remainder of this decade, or close to 50%. Most of this increase is expected to be in China and other emerging Asian economies, especially Southeast Asia. Remember also, Russia is becoming a very big player, but their resources are very limited also in terms of conventional gas. And now the competition is going to be Australia, Russia, US, and maybe Canada, but Canada is going to be latecomer, so I'm not sure on that one. Okay. If we look at China as an example, consumption of natural gas has increased dramatically as its economy continues to prosper, but also due to growing desire for cleaner energy. Basically, there is a gradual shift away from coal, but it doesn't mean that they are going to be coal-free in the coming years. Basically, they need to maintain some energy security. Even if it wants really coal-free, they really want some energy security. So combination of energy, coal, natural gas, oil, and they are going to use all of this. Looking through 2020, the expected increase in Chinese natural gas consumption is broad-based across several sectors, including power generation, taking share from coal in the residential and commercial sector as a replacement of fuel oil for heating, and in transport sector, replacing diesel. One of the important factors going to determine all these prices and everything is going to be trade direction. If we look at the implication for global natural markets, one thing we have to be talking about what's called trade direction. Historically, natural gas trade were mostly regional via pipelines, as I said. There are limited global LNG trade in Europe and Asia. With growing domestic supplies, North American producers are looking to export excess natural gas to other continents. As shown in the early previous graph, US is building major LNG export capacity in the Gulf Coast, and exports will be ramping up all through. So the question is whether LNG exports will be profitable if we send it to Asia or Europe. With the current low prices, I don't think it is profitable in either continents. But as I said, by 2017, we do expect oil prices moving upwards. And then since oil, especially in Asian market, gas prices linked to oil prices, so we are expecting gas prices to rise as well. So still, we are going to be seeing some profitable LNG export to especially Asian markets. How many minutes I have? Oh, okay. So that's fine. There are risks, of course, to outlook for LNG. For example, cost escalation has been a major challenge facing LNG project worldwide. Unit cost for liquefaction plants in real 2014 dollars increased from average of 320 per ton between 2000 and 2006 to $850 per ton from 2007 onwards. The run-up in cost is especially pronounced for brand new greenfield projects. In particular, Australia experienced cost overrun in the range of 30 to 50% with the rapid development of export capacity over the last 5 to 10 years. With exchange rate fluctuation and shortages of skilled labor acting as key drivers of cost escalation. Looking at the next 5 years, will the same cost overruns plague North American exporters? If that is the case, of course, that represents a downside risk to the proposed LNG export capacity. On the other hand, much of the outlook for LNG demand depends on how much consumption growth takes place in emerging Asia, especially China. While most are confident that demand growth in that region should remain robust, recent downturns in their economies have raised some concern. If we look at here, changes to global gas price structure, we are seeing that move from oil indexation to much more market prices. The last implication of shale revolution is its impact on the market pricing structure in Europe and Asia. Unlike the natural gas market in the US, natural gas prices in Asian and part of European markets typically reflect long-term contracts that are indexed to crude oil prices. There is currently no globally integrated market for natural gas, so pricing mechanisms vary by regional markets. Internationally traded natural gas has been largely indexed to crude oil prices such as North Sea Brent because of liquidity and transparency of crude oil prices and substitutability of natural gas and petroleum products in certain markets. For example, some Asian countries have the option to burn either natural gas or petroleum for electricity generation. Here, basically, although long-term crude oil index contracts remain Asia dominant pricing mechanism, natural gas is becoming to be traded on the spot market as one-time transaction or under short-term contracts. This is partly driven by the fact that the global LNG market is growing rapidly in capacity, with both more suppliers and consumers making the market more competitive. Shale is one of the triggers of this shift because of the expected injection of US gas into the world markets in coming years. As you can see, growing share of Asian natural gas trade is based on short-term spot contract rather than long-term oil index contract. So it is the buyer world rather than seller world. How about oil markets? That is my area actually, much more closely I follow the oil market. So if you look at oil market, it's basically same with what happened in the shale gas. Similar to experience of natural gas, US oil imports have also fallen in recent years, reflecting the surge in domestic production and weakening consumption. However, falling US imports demand has not affected all suppliers equally. Demand for imports from Canada is still rising. Imports from Saudi Arabia and Mexico has declined only slightly. Most of the decline involves volumes flowing from West Africa, where most of the oil are very light ends. Shale production is basically, it is lighter than actually WTI. So it just replaced all the West African oils. And now basically they are blending this shale oil with Canada very heavy oil to use in these refineries which are in the Gulf. They are only configured to actually process heavy oil. they cannot process light oil. That's why we are seeing some price stuff over there also. Okay, oil extracted from shale formation are considered, as I said, very light grade oil. This is why rising domestic supply in the US has so far mainly displaced imports of light oil, those from West Africa. On the other hand, US refiners, who along with most everyone else didn't anticipate the shale revolution, made hefty investment to acquire refining capacity to process heavy oil over the past decade. Between a third to half of the refining capacity in the US Midwest and Gulf Coast are now capable of processing heavy oil rather than light oil. It takes further investment and time for refiners to revert back to capacity capable of processing light oil. This may not be economic, especially given stable supply and relatively low cost of Canadian heavy oil. That's why they enjoy very high margin by importing more Canadian heavy oil. This increase in US oil supply has exerted substantial downward pressure on oil prices, although its impact was not visible immediately during up until 2014. Despite the steady increase in US output between 2010 and mid-2013 that exceeded previous expectations, global oil prices held steady at around $100 per barrel. This is because the increase in US output was largely offset by other developments. For example, unplanned outage of OPEC increased during this period as a result of the conflicts in Libya, Syria, Yemen, and also Iraq problem with the Islamic States. Not only did these conflicts disrupt physical supply, they also added to risk premium associated with instability in the Middle East. And the second one, infrastructure limitation and export policy constraint prevented US shale oil from reaching other markets where demand was high. Oil was essentially trapped in certain places while other regions had a shortage of oil. In the second half of 2014, US output continued to climb while unplanned outages in OPEC abated somewhat. Libyan oil came back, as I said before, almost 800 kbd from June of 2014 to August of 2014. These developments, of course, were the initial triggers for the sharp decline in oil prices since mid-2014. Other developments since mid-2014 had accelerated the decline in oil prices, including the shift in OPEC policy, weakness in the global economic activity. The sharp decline in oil prices is problematic for shale oil producers because they are among the higher cost producers in the world. However, I do believe that the main target of Saudi policy is not shale producers, where their production is much more flexible than other high-cost producers, such as Canadian oil sands and deep water and other high-cost producers. Since the flexibility of shale oil makes almost impossible shale Middle East producer like Saudi Arabia to stop completely the production or development of shale oil. So whenever price increase, shale oil producer will come back and fight. And also we have to be thinking shale operating cost is relatively low. So although price decline, their production will continue to increase. Okay. Although here again, number of rigs decline, but production stayed constant because of what you call technological improvements and rig efficiency. As I was talking 2 weeks ago of one Eagle Ford shale producer, it was taking 44 days to drill one well. It's now only less than 20 days. And today I was talking, it was taking almost 30 days. Now it's only 8 days. So you don't need the same number of rigs now to produce same number of production. So it is productivity gains surprised us all. For example, including myself, I was telling people, okay, you need to keep drilling in order to produce the same amount. But the number of rigs declining, so eventually production will decline. We were expecting by second half of 2015, US production should go down a lot, but it did not, thanks to productivity increase. We did not forecast. Okay. Let's be clear, first of all. As I said, shale is not the most expensive oil resource in the world. There are much more expensive resources, like oil sands or deep water. Currently, we are guessing or forecasting, guessing that full cycle shale costs about $55 to $70, while full cycle cost of oil sands is about $70 to $80. And then we are expecting further technological improvement can cut the cost by another 25%. Some of these costs are cost-cutting stuff are going to be permanent. Therefore, we should expect shale production continue to be around, and whenever price increase, they are going to respond back very strongly. Okay, but that doesn't mean that shale producing and the OPEC decision not to respond makes actually this market much more volatile, because now we don't have the spare capacity of Saudi Arabia. Whenever price declines or increase, they were reacting, but now we don't have that one. So, how about shale oil implication for the global oil trade? Now, it's now important to note that even prior to shale revolution, there was important shifts taking place in the world energy market, with the new demand centers emerging in the East, namely China. Chinese oil consumption has surged over the past decade, and it has been the main driver of global oil demand growth over this period. That is expected to remain the case through 2020. After that, India becomes a much higher growth center for oil demand. U.S. oil shift, U.S. shale fits in this large picture is that it is making it easier for this shift to take place. Basically, what I say, production is moving to west, consumption is moving to east. We cannot no longer talk about OECD demand is the main driving factor for global oil demand. Rather, non-OECD demands, especially coming from Asia and East Asia, is going to be much important. Here, with rising U.S. oil outputs, of course, aided by steady increase in Canadian oil sands, the U.S. is becoming less reliant on oil imports from other continents. U.S. has already shredded its reliance on West Africa and North Sea supplies, essentially allowing those volumes to be redirected to growing market in Asia. Basically, this chart shows that IEA expectation of oil trade flows in 2020. Of the numbers in bracket represent changes in level compared to current flow. North American imports from abroad is expected to decline further, and those volumes from Latin America and Middle East will instead head to China and other emerging Asia. How about long-term outlook? Basically, as you see here from here, outlook for natural gas demand through 2040. This one, the biggest increase coming from other non-OECD countries. and also China demand and India demand is still growing. Here you can see the importance of unconventional gas production. This is also basically Shale has been increasing, while incremental increase in conventional gas is limited. This is outlook for oil demand through 2040. Basically, we are expecting to reach about 96 million barrel to 2040. And of course, most of the increase is coming, again, India and other non-OECD. As you see here, China growth number is declining over the years. This is also, again, this is not surprising, as I showed it to you. The reserves for shale oil is much more limited than reserves for shale gas. And again here, although main incremental increase is coming from shale oil, almost 90%, 95% of oil is, again, conventional. So how about the risk to this outlook? What will happen to the production cost? As I said, shale is relatively expensive, but not the most expensive one. Will costs come down via efficiency gains and technological improvements? We are expecting, yes, 25% or some more, and maybe more. If that is the case, what will happen? So, do we think Shale become really the swing producer rather than OPEC? Or will cost runs over plague producer? The second question, the most important one, is Shale viable outside of North America? Do they have enough technological improvement, or do they have the labor? That's the problem. For example, Argentina. Do they have the required laws to protect property rights and all this stuff? And then the second is Shale needed? Basically, Iran is an important risk to both oil and gas. Also Iraq. But I was talking to Iraqi oil minister 2015, 2011. He was expecting, at that time they were producing only 2.5 million barrels of oil. And then he was expecting to increase oil production to 12 million barrels. That was surprised everyone. And I mean, they said, what's happening? We were expecting at that time 4 million or something. And I was working at the IEA at that time. Of course, now the current situation, 4.2, they are still expecting to increase their oil production to 6 million barrels by 2020. This then almost 1/3 increase. So one increase coming there. And then Iran has ambitious plan of increasing its output to 5 million. If that is the case, we are getting almost 4 million barrel increase in production from these two countries. So do we need shale oil? The thing is, always, they do have some rosy picture, and they never bring what they promise. So we are going to need high cost production. We are expecting 3 million barrel extra shale oil is needed by 2020. Okay, let me conclude. Of course, shale revolution is a game changer. A lot of people suggest that recent decline in oil prices has nothing to do with the shale. But in our opinion, shale production has contributed immensely to the decline in oil prices. Basically, OPEC decision plus shale production, increase in shale production and decline in outages led to almost 50%, more than 50% decline in oil prices. Shale production also make possible U.S. energy self-sufficiency. By 2020 or something, we are expecting, especially in terms of U.S. is going to become major net gas exporter. North America become energy independent by mid-2020. Shale revolution contributing to the shift in landscape in world energy market. Basically, flows have been changed, and then trade map has changed. And of course, shale revolution is helping to change market structure, from moving oil indexed long-term contracts to spot or market prices, even in the Asian markets. So, shale oil challenging OPEC as the main supply side adjustment to balance the market. Although it might not be as flexible as OPEC, but the flexibility has increased a lot. Therefore, the elasticity of supply increased a lot. We can no longer talk about very inelastic supply or something. So elasticity has also improved. This is my talk today. Thank you so much for listening. If you have any question, I can take.
Thank you very much for an interesting talk. I guess my question for you remains, the last illustration you were showing projecting out to 2040, how much of that is socioeconomic, political in your projections, and how much of it is also due to the fact that there may be other sources of energy such as solar or wind? You mentioned it early on. Do those factor into your projections looking out at world market? Yes. Out to 2040? Yes. So that's all factored into that?
It is factored in. Basically, our assumption is about, prices is moving upwards. It's about $80 or something by 2020, and it's all factored in. Especially, yes, now alternative energy cannot compete with fossil fuels, but we are still expecting some growth in alternative energy.
So how is the percentage of how much solar is being used to meet market demand, or wind power, is that staying constant, or are you assuming it'll?
It's increasing.
Thank you.
Especially wind power.
I have a question. Your very last bullet in terms of elasticity and basically, I think this points to a price point for the break-even price in North American shale markets. And so, does this indicate that you would project that kind of at least a mid-term elastic price average being around $70 per barrel for oil, if that's where the price of Bakken oil is sitting?
Our medium-term oil projection is about $70 by end of 2017. That's not where Bakken, but that's where Canadian oil sands sits. Okay. Exactly. But as I said, Bakken is not going to be the 60. Marginal. Okay. 55 to 65. Yes. Okay. That's true.
So I have a question. You commented a little earlier about refinery capability in the Gulf states. And if I understood you correctly, you were talking about the capacity of those refineries to handle crude. It had to be heavier. And what we're producing from the shale gas is lighter. And so it got me to thinking about the XL pipeline, Keystone XL pipeline. How important are those Canadian heavier crudes to the U.S. oil markets in the Gulf states, and combined with the shale gas and the shale oils? Yes. So if you want to comment on that.
Yeah, basically, for time being, all the pipelines are enough to carry what you call supplies from Alberta to Gulf, but increased production or increased demand from U.S. is not going to be what you call without XL, Keystone XL, it's not going to be enough pipeline. So it is very important in the longer term, especially after 2016 and onwards. But for the time being, these refineries really needs heavy crude. They cannot handle the light crude. If they want to use U.S. crude, which is light, they have to blend with the heavy crude. That's what they are doing right now. The blending is about 30 to 70%. 70% heavy. Although they basically stop importing from Venezuela and Mexico, while they are importing from Canada, because Canadian oil is much, much cheaper. Just think about sometimes the spread between WTI and Canadian oil is $25 to $30. So this gives refineries big incentive to import from Canada, because Venezuelan or Mexican oil goes above international prices. Still, Canada is going to be a very important source of.
Question for you.
So I want to go back. I'm not sure if this is working. I just want to go back to the question Dean Cilento asked, which is how much of the pricing of oil is actually, there is a political dimension to it? Because my understanding is in Iraq, there are places where oil just comes to earth for basically for $2 a barrel.
Yeah.
That is the cost. So there is a huge political component to all this, right, in terms of what's the price of oil, right? What's your take?
Yeah, basically, if you look, Iraq is a little bit different, right? Because Iraq is a mess. You don't want to talk about the production cost because it's the security premium over there. I just want to talk about Saudi Arabia. There is not much security premium. $5 operating cost, total full cycle cost is about $20. Iraq, if you don't include any security, it's about $35 total cost. If you look at Iran, it's about $35. Basically, Iraq is competing with Iran in terms of, and on the other hand, Venezuela is about $60, while US is right now $55 to $70, and then Canada $70 to $80. Yes, there are political dimension, of course, always. But the thing is basically, even with that political dimension, even if you add the security risk premium or geopolitical risk premium, the cost over there is much, much lower than North American oil. Still, I mean, you cannot say that, oh, I'm going to go to Iraq and produce oil with $2. No, because you need to take with you some labor. Their labor quality is not enough to produce. So how are you going to take? You have to pay some premium to this labor or to this machinery. There's always risk that you can lose those labor and machinery in Iraq. So.
Another one. So I know you said that oil is your specialty, but you do know a lot about gas and gas markets as well. And so we have a global oil market right now, but we don't have a global gas market. Although a lot of investments that are coming down the pipe, you showed the graph in terms of LNG export and investments, that pushes us toward a global gas market.
Yes.
In terms of the global supply that's out there, the global demand, right now, Asia, particularly Japan, it's linked to the oil price, but in North America, we saw the decoupling in
Yes.
oil and gas price in 2008. Where do you see the balance in building the global gas market, and will we ever see a recoupling in North America of the oil and gas market as we build export capacity in North America?
If you are talking about gas market, yes, that is the direction we are going with the LNG market and all, especially with LNG export capacity that will make almost oil indexation will disappear in the longer term. But the thing is, the shale oil, almost abundant almost everywhere, if they start building, do we need LNG export? because pipeline is always much cheaper alternative than LNG export. So there is that stuff also becoming regional again. But our stuff basically, yes, that is a probability, but it's very low probability. We are expecting that much more market-based pricing system than currently we are observing. And of course, that means that we are going to have, I'm not going to say truly global, but much more global gas market than currently available.
Today.
Yes.
If there are any final questions, a last question, because we can adjourn and have more conversation over in the Kennedy Club Room. We do have one poster from Dr. Usha Haley. If you'd like to just say just a few words about what you've brought to share with the group on your poster in the Kennedy Club Room.
The past couple of years, I've been looking at Chinese investments in U.S. shale gas. And it started out because of a little bit of funding that I obtained from Trina Winkle's group. And then I went on and I worked with the United States China Economic and Security Review Commission and the United States Congress, and then they gave me a lot more money. We've been looking at China has become the largest investor in U.S. shale, foreign investor. And what I'm looking at is whether, I do take some degree, I mean, there's some controversy surrounding gas estimates both in the United States and China. So for example, I noticed that you put up a lot of IEA data. The IEA themselves are not so sure about it. And there actually was a University of Texas study that looked at estimates of shale gas around the country, and they came up with about a third of what the IEA has come up with. And IEA has underestimated or overestimated Chinese production of shale gas. Currently, only the United States and Canada are the two economically viable producers of shale gas in the world.
Correct.
And China, I've been looking at those figures from China. China is about 10 years away from producing, by their own estimates, economically viable shale gas, although they do seem to have the largest resources of shale gas in the world. Extremely difficult to extract.
No.
So what I'm looking at is I've now been talking to the Council of Economic Advisors for President Obama. And one of the concerns is that President Obama made some statements saying that the United States is going to become energy independent because of the shale gas revolution. But these are based on estimates and technological trajectories drawing on investments by DARPA and of course, Morgantown, Seminole Gold and the whole thing. They don't take into account state capitalist investments and the different trajectories that could happen there. So I'm seeing what happens with shale gas development, whether it does become more efficient for the United States or whether there could be some alteration for China. There's also a lot of discussion, it isn't a foregone conclusion, on the exports of LNG from the United States. We simply do not have the infrastructure currently. There's a huge backlog, and it may take, 3 to 5 years before some terminals are put up. There's going to be a lot of wrangling on this in Congress, for example, so it's not a done deal. Because the estimates of shale gas are not universally accepted. I mean, I noticed you put up all the IEA figures, and the IEA is the leading authority on it. But you'd be surprised if you go and talk to them as I have. They're not so sure about their own estimates. They're really guesstimates. Because, for example, they take into account, the shale gas reserves in the United States, take into account populated areas like New York City, where you really cannot drill for shale. So that it could well be that the United States simply does not have the shale gas reserves. We certainly know that China's are not economically viable, at least for the next decade. And there's some concern about what all this investment is, Chinese investment is doing to the United States and to our technology. So that's what the study's about.
Okay.
So,
Let me answer a few.
sure, go ahead if you want.
For China, I totally agree. Basically, I did not say that China is going to produce shale gas or shale oil. Shale oil production, now it is almost zero, and then we are expecting by 2030, it's only 600 KBD.
Right.
That's it.
But it's not economically viable.
We are not expecting on that one. For US independence, our analysis did not basically show that U.S. independence in energy, North American independence in energy. Okay, it's not U.S. independence. And then for export, LNG export, still we do see already Energy Department and all FERC already approved some stuff. So we are going to see 2017 and onwards export of LNGs.